There's a great quote by the French author Michel Foucault who basically states that the only proper place for a thinking mind is the fence. We need to be skeptical about pretty much everything, pretty much all the time. We need to weigh information on both sides. We need to come to our own conclusions and make informed decisions about what we're doing. And that's very much important in technical analysis. And I wanted to continue the last slide where we were talking about making predictions versus making forecasts. And I want to use a couple of examples. One of those is going to be forecasting weather. If you have basically existed in Western society, you've made use of a weather forecast. And weather forecasting is very similar to what we do in technical analysis. It is imperfect. It doesn't always work, but it uses a vast amount of information. It requires experience and educated analysts. It provides us most likely scenarios about what is going to happen in the future. We use historical information to say what has happened when these conditions were present. We look at the outcome of those situations and we apply that information to what's going to happen in the current context. Price action, weather information, both of those things result in a potential forecast. So, forecasting requires what? A collection of information and data, an experienced analyst, investigation, a creation of most likely scenarios given the information that's provided, and just like in trading, forecasting becomes a major part of our day-to-day decision making. Do you check the weather before you go to the beach or go fishing or go outside? I'm willing to bet that you do, and weather forecasts are an important part of your day-to-day life. Now I have another quote for you. It was given to me by someone I used to work with called Silly Person. And they often said almost every day, how can anyone be so wrong so often and still have a job? The weatherman is terrible, and this person basically ripped on the weather forecast all the time like it was their main hobby. And I was always so astounded by this. The fact that someone could so easily tear down a career based on so much information. I had the opportunity to take a Earth and Atmospheric Science course about weather patterns when I was in university, and it was incredible how much information we learned on the most introductory level. Weather forecasting involves hideously complex weather systems. There is so much data available that needs to be parsed and interpreted, and then very fundamentally presented to us as end users of that information. There's a monumental amount of data there, and it takes years of education, lifetimes of experience to read and interpret these weather forecasts, and I find it absolutely incredible that we have the predictive abilities and the accuracy that we do for weather. And I've got this example here of how forecasting works, the accuracy of it over time, and we can see that forecasts within 3 days have a 95, almost 100% accuracy, and the further out you go, the 10-day forecast, not very great. It's very similar to what happens in the market. When we have short-term patterns, we know relatively confidently what's going to happen in the short term, but we lose that resolution and that accuracy as we extend out over time. So is the weatherman wrong? Yes, he can be wrong. Can a market technician or technical analysis be wrong? Yes, absolutely. But we take the information we have, we make our most informed decision, and then we take action based on that. Let's talk about blackjack as an analog for the market and counting cards as an analog for technical analysis. Blackjack is a casino game where you place a bet and you collect cards and you try to get a combined card score of 21 without going over. The dealer's also playing. They're trying to get as close to 21 without going over. And ultimately, whoever has the bigger card score wins the pot. So just like the market, blackjack on its own is simply luck. We have no control over the prices that we're given. We have no control over what cards we're given. It is completely up to chance if we are making uninformed decisions. Now, card counting is a lot like technical analysis because it allows us to plan for potential outcomes by better understanding the market conditions. In the case of counting cards, and I'm no expert on counting cards, you would generally assign a point system to cards that are 2, 3, 4, 5, 6, 7, 8, and you assign a minus point system to face cards or tens. You keep a running total, and you use that running total to your advantage by understanding the most likely outcomes of your next draw. If you have a high card count, it means that most of the smaller cards, the 2s, 3s, and 4s, have already been in play, so you're more likely to draw a face card than you would have without keeping track of what's going on. This allows you to plan for potential outcomes and have more informed decisions about what's going to be coming up from the deck. It allows you to adjust your risk profiles based on the conditions that are present, and it allows you to make better decisions overall in your game. Counting cards and technical analysis are a means to profit from the odds. It's not predicting, it is profiting from odds, a better understanding of what can be expected based on the conditions that are present. So now we have an understanding of what technical analysis is. We gather information, we make decisions, we look for potential outcomes. How do we use that to actually make money? Well, it's easy, right? We buy low, sell high, or cover low. It's not that easy. If it was, we would just use a computer to trade. And I know that there are algorithms and there are funds who've had success with algorithmic trading and robotic trading. It does exist. It is a thing, but it is very difficult to do. There's a lot of noise in financial data. The vast majority of the price action you see is complete nonsense. And using that information to make trade decisions can be very difficult. You can go all day and have very, very little information or patterns or anything in technical analysis that can give you an advantage. Sometimes it's just noise, and parsing all that noise can be very difficult. Technical analysis is also a bit of an art form. It's very subjective, and different analysts can read different situations differently. Coding subjectivity and experiential knowledge into an algorithm is very difficult. If I'm looking at an EQ pattern, I can tell you when an EQ is likely to break bull or bear. I can tell you when an EQ is just not working, and they look very similar, and it's all based on experience. Coding experiential knowledge and subjectivity into an algorithm is very, very difficult, if not impossible. And as I just alluded to, technical analysis is very much an art and very much a science. It's a mixture of both of these things. And it's very difficult for a computer to understand art in the format that we are presenting it. So how do we make money? We use the art and the science of technical analysis to make trade decisions. So we know that technical analysis provides us potential outcomes. We can use it for planning trades. What are these charts actually giving us, though? What is the visual representation of data able to provide for us by itself? Well, charts can tell us when prices are in a trend. We can look at that meandering price action, those consistent higher highs and higher lows, and we can jump in on where we expect to see that higher low and profit from it. We can stay inside the trend. We can recognize it. We can also recognize when the trend is changing. If we have a support level and we drop through that support level and we backtest it, something is happening and the trend is no longer going to be intact. And the beautiful part about the chart is it can confirm when a trend has changed. If we drop through the support level, we hit it again as a resistance, and we reject further, that trend has changed and we can make new trade decisions based on that information. The charts give us information on when we should enter a trade, when we should exit, using support levels, using indicators. And I think the most beautiful part about technical analysis and charts is you can determine when your original analysis was incorrect. You can have the most beautiful trade plan. You can convince yourself that things are going to be moving to the upside with every indicator, with every support level, with every little piece of information. But if you're wrong, the price moves in the wrong direction, you instantly know that your analysis was incorrect. You can get out of your trade with minimal losses, and you can live to trade another day. That is what charts can provide. So why does technical analysis work in the first place? In order to support technical analysis, we got to make a couple more assumptions. And we're going to talk about them, and mostly it's about price. So the number one assumption is price is supply and demand. We assume that the price is the summation of everything in the market. It is everyone wanting to buy, everyone wanting to sell, everyone telling their parents to go buy Tesla or to short weed stocks. It is everything. Price is the only thing that matters because it's the only truth in the market. It accounts for everything. Every bit of news, every bit of fear, every bit of technical information is all in prices. And prices are not random because they are the summation of everything in the market. We also know that history repeats itself. If we have a pattern that is happening time and time again, we can bet with relative confidence that the same behavior that we have seen every single time is going to repeat itself. We also know that trends and patterns are fractal. We can apply the knowledge that we see on the 5-minute time frame, and we can apply that to a monthly time frame. We can look for bull flags on a 15-minute chart, just like we can look for it on a daily chart. They all follow the same rules. And lastly, we can assume that the market operates on feedback loops. If the market is bullish, You're going to be excited. You're going to tell your friends. Your friends are going to be excited because they want to make money. They'll put money into the market. The market's going to go up because there are more buyers. You're going to be happy because you're making more money. And it continues and continues. That is a feedback loop. It can also operate negatively, where you start to feel fear. You sell your stocks. You tell your friends. They sell their stocks. The idea that the market was going to drop is then reified because everyone else is selling their stocks, and you feel confident that you made the right decision, spreading more fear. This is a feedback loop, and this is generally what feeds these trends that we see over time. So using all of these assumptions and treating price as the ultimate truth of the market, we can use technical analysis to make fantastic trade decisions. The only truth in the market is the price, and that is the only thing that you should be concerned about. So in summary, what is technical analysis? It's a tool that allows us to gather price information, indicator information, patterns, trends, and we take all of this data, we parse it, and we adopt a trading strategy. It lets us recognize trends and changes and lets us flow with the evolution of the market. It lets us create a trading plan using that strategy, using the recognition of the trends, and using that information that we've gathered. And it lets us mitigate and manage the risk. When we enter a trade, we know which way it should go, and we know how we can recognize it if it goes against us. It allows us to set our stop losses and mitigate those losses so we can keep trading without losing money consistently. It allows us to create and execute a trading plan, and most importantly, it allows us to react to developments. A trend is in place until it is no longer in place. And what happens at those moments of change can be the difference between being a profitable trader or an unprofitable trader. Technical analysis allows you to do all of this. And the rest of this course, we're going to talk about some key aspects, some basic aspects of technical analysis, and give you a little bit of idea and education on some of those fundamental concepts. So thanks for sticking through the introduction, and let's get into some chart discussion.